Good morning, everyone. I'm delighted to have the opportunity to present my paper to you about international financial reporting standards on credit unions in Canada. And this is a paper I've written with my co-author, Karen Lightstone. As you probably know from your conference program, I'm with St. Mary's University in Halifax, Nova Scotia, Canada. We're on the east coast of Canada, and I'm the Executive Director of our Centre of Excellence in Accounting and Reporting for Cooperatives. Okay, so looking at the purpose of the study, we wanted to look at the impact of the adoption in 2011 of IFRS. We wanted to see what the impact of that was on credit unions. We wanted to look at their financial position and, more importantly, some of the impact that that had on their key performance indicators. So we wanted to see, because we were thinking it was going to impact their KPIs, that we wanted to look at that in particular as it relates to comparability. And this is really important in the credit union sector because they spend a lot of time comparing themselves and benchmarking to their peers. So obviously, if they were impacted by IFRS, then that would have an impact consequently on their key performance indicators and their benchmarking. So the context for the study is that despite the differences, obviously the differences between a cooperative and an investor-owned company, the credit unions in Canada met the criteria of being publicly accountable as set by the accounting standard setters. So even though they don't have a profit maximization goal, they're still required to adopt IFRS. And as I mentioned earlier, measuring and comparing performance is extremely important in the cooperative union sector. So I've done previous studies, and I found from my previous studies with the credit unions that they measure their own historical trends, but also devote considerable time comparing to their peers, particularly those of a similar size, and also to the for-profit banking sector. So continuing with the context for the study, in my prior studies, when I asked respondents to rank key performance indicators, now I keep referring to those as KPIs, to rank them in order of importance, they gave a very high priority to financial indicators. So my study found that the most important financial KPIs was the efficiency ratio, growth of assets, return on investments, return on assets, and profitability. So a quick review of some of the literature that I looked at. First of all, there was some literature regarding the improved quality of accounting data and market reaction on European firms. Others showed there was less earnings smoothing, lower loan rates to IFRS adopters. Another section of my literature review looked at the impact of IFRS specifically on EU banks, and again there's a variety of findings. Looked at again found that IFRS improved earnings quality. It enhanced the information content of earnings and book value. KPMG found, though, that IFRS adoption did not change the indicators reported by the banks. And another area of the literature review found that IFRS doesn't necessarily address all the interests of the wider stakeholder groups. And Maddox, Hicks, Robb, and Webb, they found that it does, IFRS, not surprisingly, doesn't really reflect the unique nature of the cooperative enterprises and the principles. So given that one of the primary goals of IFRS is to improve global financial reporting comparability, it's important to understand how the adoption of IFRS actually does impact comparability within the credit union sector. Okay, now looking at methodology, we looked at the top 50 credit unions in Canada as measured by assets. And even though it was the sample was comprised of the top 50 credit unions, it this group does represent 87% of all Canadian credit union assets, excluding the province of Quebec, because they're on a bit of a different system. So the data source of this was from the Industry Association. So look here at the descriptive statistics, and that's outlined in the paper, so I won't get into details here. The directional impact of adopting IFRS. So this slide is showing on the first line, for example, that of the credit unions that we looked at, the 50 that we looked at, 77.3% of them had an increase in their assets. 68% had an increase in their liabilities, 75% of them had an increase in the equity, 31% increase in revenue, and a 13% increase in expenses, and net income had an increase of 43%. And I won't repeat the rest of the slide there, but you can see that certainly the majority of them were, of those who reported it, they were impacted by IFRS. And a very small percentage reported no change. And we did have a number that didn't report on the change. There wasn't any information in their note disclosure in their financial statements. When looking at the findings from the perspective of early adoption, the standard setters allowed early adoption. So IFRS was set to occur January 1st, 2011, but you had the option to implement this as of 2010, and most of the credit unions in our sample, 90% of them, did choose to go with early adoption. So looking at the first set of findings, return on assets, we would define a positive impact if net income increased while there was no change or decrease in assets, or if there's a change in net income while total assets decreased. Similarly, there would be a negative impact if assets increased while net income decreased or did not have any change. So of those credit unions reporting, 22% experienced a negative impact, 2% had a positive, 42% the case was immaterial, and almost 33% did not report their results. Growth of total assets. The growth of total assets was positive as a result of adopting IFRS in 69% of those reporting credit unions. Of the remaining credit unions reporting, 12% found IFRS had a negative impact, and impact was not reported by 18%. The next finding relates to return on equity. Here, I won't go into the definition. You can read how we're defining negative impact and positive impact. So what we found was that return on equity, the impact of IFRS on return on equity, was not reported by almost 33%. However, IFRS adoption had a positive impact for 22%, 2% had a negative impact, and 42.6% was a negative or was an immaterial impact. The next findings related to the KPIs, the efficiency indicator. So the efficiency indicator is defined as expenses relative to revenue, and this is a KPI that's heavily relied upon by the credit union sector to determine their level of efficiency in their operations, and they're very keen to compare this to other credit unions. And again, I won't labor the point of defining what constitutes a positive, negative, or immaterial impact, but one thing that is concerning is that 61% did not report the impact on their efficiency ratio, when clearly it would have had an impact, because we saw from previous slides that there were changes in their revenues and expenses. 18% did report a positive impact on the efficiency ratio, and 6.1% reported a negative impact. Now I'll move to some conclusions from our study. First of all, it's quite likely that comparability will be compromised by the significant percentage of credit unions that did not report the change in their revenues and expenses, and I presented that slide early on. The study also found that credit unions didn't discuss the impact of IFRS on their KPIs and on benchmarking. So here we're thinking perhaps it was assumed that the changes would be proportional and therefore not impact the comparisons. There were some limitations in the study, as I've mentioned earlier. The fact that changes in revenues and expenses were not reported by 47% and 40% respectively. It's possible that those not reporting on the impact could mean there is no change rather than just not reporting it. That's possible. As a result of the absence of these details, however, the reader is left to speculate, and certainly notes to statements should not be leaving the reader to speculate. So another limitation of the study was the fact we didn't base it, of course, on a statistical sample, and so it can't be generalized to all credit unions, but since it was based on the 50 credit unions comprising 87% of the total sector, it does give considerable insight into the impact of IFRS on the industry. So for future research, certainly the obvious one is that we could examine the credit unions that did not report the data, try to go back to them and see if we could get that information. The next area would be to include all of the credit unions making up the remaining 13% that we didn't include. So these would be very, very small credit unions. And another fruitful area for future research includes an investigation of the impact of IFRS on Canadian banks compared to credit unions. So thank you for listening to my presentation, and before I finish up here, I just want to do a little commercial to let you know about a journal that the Center produces. It's the Journal of Cooperative Accounting and Reporting. It's peer-reviewed, online, free, open access, and we, in addition to pure accounting, taxation, standard setting, we also look at social environmental reporting, measurement and analysis, financial management, public responsibility, ethics, knowledge and innovation management, systems management. So quite a broad array of topics that we do cover. And I'm the editor of the journal, so if you have a paper, if you're not sure if it would fit with the journal, by all means email me, let me know. My cutoff date for the next edition is November 30th, so if you have a paper you'd like to submit, we'd love to hear from you, and just send it to me by November 30th. And in the meantime, if you have any questions, feel free to get in touch with me. My email is noted there, and to find the journal is coopaccounting.coop. So thank you for inviting me, and I would love to be there with you in person. Brazil is definitely on my bucket list of places to visit, and hopefully next time I'll certainly be able to attend in person. Thank you.